Thanks for joining this week's GoErie live discussion. Today, Erie Times News business reporter Jim Martin will be talking with William Finnessy, partner at BKD CPAs and Advisors in Erie. Thanks to Gannon University for sponsoring these live discussions every week. Enjoy the conversation.
Bill, thanks so much for joining us this afternoon. This has got to be a really busy week, busy time for you. Realizing this is less than a week from the tax filing deadline. Are you as busy right now as I would imagine?
Yes, we are. And the Tax Cuts and Jobs Act that was instituted, written into law December 22nd of 2017 is really throwing us all for a loop. There's a lot of provisions in there that are affecting the individuals as well as the businesses, and more so the businesses. They're the good provisions and difficult provisions and a lot of planning opportunities, and takes a lot of thought process to make it right. And so what we're seeing is a lot of delay in tax filings right now, Jim, because of those decision-making processes, as well as making sure people take advantage of the tax law properly. So in a lot of cases, we're having some returns on extension, more so than that we would have in the past.
Well, let's talk about the individuals first.
Sure.
Are there, is when you get down to a situation like this where you've just got a few days, whether or not someone's going to professional using tax prep software, whatever they're doing, is there a greater opportunity to mess this up? Or do you see people make more mistakes? And how do you avoid that?
Sure. So with the with this time of year, you obviously are under a lot of stress. You as the individual, as well as then the tax preparers, the CPAs that are performing the services for you, and/or you're rushing to get work done through Intuit or the other tax software packages that you may be using on your own. You want to slow down, you want to recalculate, you want to be careful, and you want to follow the instructions on the forms and the instructions that are provided to you on the tax software programs and the diagnostics, as well as your CPA. So slow down, take some special attention, and just know that you can go on extension if you feel that you don't have the time or are not properly prepared. You can go ahead and do that, although the time to do an extension is due by April 15th, but you would have, it does not extend the time for paying the tax.
So I think that's the complicator, because if you owe tax, I mean, how do you get a sense of what it is that you owe?
Good, very good question, Jim. So what I would do is look at my current situation and run through a quick calculation back of the a napkin, otherwise get some rough idea where you stand. If you really are unsure, then you would go back to your 2017 tax return, assuming that your tax situation hasn't changed all that much, and say, boop, that's where I'm at. Compare that income, apply a basic tax rate to that, and then look to see what you've paid in already in withholdings through your W-2s or your 1099-Rs, your retirement monies, or otherwise, and/or any overpayments you had from last year, as well as any estimated tax payments that you made. Add those up, subtract those from that tax liability, and if you have a balance due, you need to pay that in by April 15th using Form 4868. That's the extension for filing federal income tax returns. And then, of course, you would make a payment in for the state of Pennsylvania at 3.07%, and then your locality generally at 1%.
Is it something people should really be looking at as we get closer to the deadline? I mean, I think a lot of people are programmed to, we've got to get these done on time. Basically there's no shame in an extension. Is that something people should really consider in a lot of cases?
Extension is fine, Jim, perfect. There's no reason to not do an extension. It does not create a heightened awareness by the IRS or otherwise. All kinds of folks are on extension for all kinds of various reasons. And this year especially, because the Tax Cuts and Jobs Act, there's a very good reasons for being on extension. But again, you do need to pay in your liability, pay in your tax due, minus what you've already paid in. And remember, if you do have a little extra, I would round up, pay more in, because you can always use any overpayment that you had for the 2018 year. You can use that for Q1, 2, 3, and 4 of the 2019 year. So you also, the problem with April 15th is a double whammy for taxpayers. You not only have to pay your balance due on April 15th, even with extension, and you need to make your first quarter payment due April 15th.
Right.
So
right.
Usually when folks come in this office, it's very difficult when we say, well, you owe the balance due, and plus you owe 1/4 of that balance due, or otherwise for your 2019 first quarter payment. And then fastly approaching after that is June 15th, which is quarter 2 balance is due. So it's a quick hit, a pull out of your bank account April 15th and June 15th.
Bill, we were talking off air about cybersecurity issues and things like that, and we hear a lot about that at the paper. People coming to us with a variety of scams, and in all areas of life. Do you hear a lot about tax scams and different ways people can be bilked out of money relating to taxes? And what are some of those, and how can people avoid those in this particular area of their life?
Yeah, sure. So as far as the IRS and the state of Pennsylvania and the localities, they will only contact you with tax notices via paper. For sure, the IRS only does it through the mail. If you're contacted otherwise via the phone or text or email, be very, very, very leery of that. Okay, so if you're using a tax preparer or CPA, you would want to go and bring that notice to them. But anybody contacting you by phone, be very, very leery of that. The other is filing your tax returns using qualified tax preparer software, Intuit otherwise, and using, of course, CPAs who are following strict cybersecurity protocols. You would also then be careful if you're in these public cafes, etc., these internet cafes, these coffee houses, etc., that you would not file your income tax return over that method of that system. Do not use their Wi-Fi. Do not use a public Wi-Fi. Use a secure Wi-Fi.
Okay. The one thing we were going back and forth prior to this interview, we exchanged some emails with your folks. And the one thing that was bounced our direction was talking about how a parent can reduce a child's tax bill.
Sure.
I wasn't familiar with this. How can that take place?
Yeah. So there's a lot of different provisions, but this provision specifically relates to the IRAs and contributions on behalf of, say, your single child who has a certain earnings limit, and it's $63,000 for married filing joint, $31,500 for single, where you can put money away into an IRA, and then you get a retirement savers credit of up to $2,000 in credit for a married filing joint and $1,000 credit for a single individual. So there are retirement saver credits. There are a whole bunch of other different credits that are out there that you should make sure you pay attention to, but that's one that's catching a lot of folks' eyes right now.
You can do that for your child or yourself, for that matter, right?
You could put the money in on their behalf. You do it for yourself. But again, you need to be within these certain limits, these income limits. So usually we're addressing our taxpayers who have children who are just starting out in their businesses, and they say, starting out in the workforce, they say, well, I don't have money to put money away for my retirement. Well, the parent can give them the money to put the money away, and then the child himself, filing as their own tax return and their own dependent, they can get this $1,000 or $2,000 credit. Again, it phases out when you get to certain income levels, etc. But that's something critical to look at. Why leave money on the table?
And I think the one thing that confuses people is, even though 2018 is long since ended, you can still do this up till
April 15th, right? The IRAs need to be funded by April 15th, yes.
Yeah, that kind of confuses people, I think. You were talking about changes in the law. Let's go into some of that, and what has changed in the last year. How does it change things for people? How does it change things in your line of work, and what are some of the implications of all that?
Yeah, well, all I can start with is wow. I mean, the Tax Cuts and Jobs Act has really changed the landscape on traditional planning and traditional tax filing matters. So first of all, the Tax Cuts and Jobs Act removed the personal exemption, so there are no personal exemptions. They replaced that with a child tax credit for dependents that are under 17. Went from $1,000 to $2,000 for everybody, and then for other dependents that are over 17 and over, and between 17 and 24, depending on certain circumstances, there's a $500 tax credit. So they got rid of the exemptions. They took the tax brackets down from a bunch of tax brackets down to 7. They reduced basically all the tax brackets by about a couple percentage points, so that most folks are going to see their effective tax rate lowered for the same type of income that would have been subject to the tax in 2017. And they took away some deductions, miscellaneous itemized deductions they took away, and they limited certain other deductions like the state and local tax that you've heard probably a lot about, right? Especially in New Jersey, high tax states, New Jersey, New York, California. The max in real estate taxes and state and local taxes is $10,000 now. that affects Erie folks as much as it affects folks in Philadelphia or otherwise, because our tax rate, you know, the real estate taxes are one item, and then your state and local income taxes are another. Well, in Pennsylvania, our state and local income taxes are 3% and generally 1%. So pretty much everybody hits that $10,000 cap.
Right.
And then everything above that is not deductible. And then the next thing is, then you would take your charitable contributions, your mortgage interest, and otherwise. And if that number is greater than the standard deduction for married, filing, and joint at 24, you would take the higher of the two. For singles, the standard deduction is 12. So what they did is they doubled basically the standard deduction for married, filing, joint to 24,000. They doubled the standard deduction for individuals up to 12. And again, you measure these two calculations, the itemized deduction versus the standard deduction, and the greater the two is what you get. Okay, so that's how that works.
You know, I hear lower tax rate, and I think people would assume, okay, I'm going to get a bigger refund. But what I keep hearing is that people say, oh, I got a smaller refund this year.
Right, but that was because the...
Walk me through that.
Yeah, the Schedule E, the Circular E, the tax withholding tables effectively took advantage of the new reduced rate. So what was happening is ratably people were getting their refund back in their current paycheck because their withholdings had been reduced by the tax effect of the Tax Cuts and Jobs Act, so that they were getting more money in their pockets during the months that they were receiving their paychecks versus all a lump sum at the end when they file their taxes. We are generally seeing, I am generally personally seeing taxpayers having effective tax rates of 2, 3, 5% less on that same income than they were the year before. Because of course the character of income matters. Capital gains are taxed at different rates than the ordinary income tax rates. You know, ordinary rates earning a regular wage versus capital gains. Those are taxed at different rates. So, but as long as your mix was the same, I bet you'd see your overall. So you need to look at the effective tax rate. That's the taxable income. That's the tax. The numerator being the tax and the denominator being your taxable income. You divide those two up. You do it in 17 versus 18, and you're going to see your effective tax rate is most likely lower.
So aside from whatever the politics might be, from a taxpayer standpoint, good news there.
I think it's great news because there's more money back into the taxpayer's hand, and I think money is much better spent, whatever your political position is on this, in the person's hand than the government's hand.
You seeing any change in the speed of processing refunds this year?
Slower, yes, because this government shut down.
It
used to be 7 to 10.
See that now?
Used to be 7 to 10 days. We're talking 2 weeks to a month now. Even for direct deposits, it's even longer when you issue a check. So where you can, beneficial. Put in your bank account information. Again, it's going right to the federal government. They have your bank account information anyways when they get your check. You know what I mean? Some people are worried about providing direct deposit amounts. I would give them the direct deposit amount. I do personally. IRS has your checks anyway, so and it's the government. It should be secure. So I think direct deposit is the way to go.
Mm-hmm. Now, you know, I guess the traditional wisdom in this is that if you're getting something close to a zero refund, that they say that's smart tax planning. But a lot of people like that chunk of money this time of year.
Right.
So if you want to see a good sized chunk of money, how do you do tax planning that accounts for that?
Okay, so if you want to see more, which I wouldn't suggest, as a matter of fact, we would like to see you owe $1,000 or less, because up to $1,000 if you owe, then you don't have penalty or interest on that. Anybody can know that? And it's almost as though you borrowed the money from the government. But in order to
know what I'm talking
use
about.
it as type of a savings plan, then what you would do is you would change your W-4, and that would, if you would lower the exemption amounts on your W-4, say down to 0 or 1, then you would have more withheld during the year from your paycheck.
And that could substantially change the results at the end of the year.
Well, it wouldn't change the tax. It would just change the amount of overpayment, or a refund or overpayment you have, or balance due that you have.
Okay. What are some other thoughts you might have on what people should be looking for, what they should be aware of right now?
Well, I tell you, we haven't talked a whole lot about the business provisions, but with those of you who are operating sole proprietorships, small, medium, large, doesn't matter, there are some significant provisions in the tax law that should be a benefit to you, especially if you're not operating in the businesses such as specified service trades or business, which is what I do, which is what lawyers do, which is what investment advisors do, which is what medical professions, others do. Those don't get this deduction, but there is a new qualified business deduction, code section 199A, and they didn't want to use code sections, but it does matter. 199A is a 20% deduction for business owners who are operating other than service trade or businesses, so meaning widget manufacturers, various folks who are just running a regular business. They can get a 20% deduction right off the top from their taxes, so that if they made X of profits, they would only pay tax on 80%. That is a huge tax savers for the small business owners. As well, the small business owners get a deduction from their capital purchases of 100% this year. Starting in 18, 100%. You purchase new or used, and that's new this year. It used to be just new, first in use with you. Now it's new or used. You get 100% write-off of your capital purchases. That's significantly helping small business owners. There are just a whole bunch of other provisions, depending if you're doing work in international markets. If you're selling, we'd like to see, Pennsylvania wants to see a lot of export. So matter of fact, they have an export through the Office of Economic and Business Development. They have an export services group, like through the Northwest Commission, and Dorothy Heffernan could talk with you about that. But those folks are helping you take your product and export to Canada, Mexico, or otherwise. There are significant tax savings for exporters. That's called the interest charge domestic international sales corporations. I'm not trying to confuse people, but there's also this foreign derived intangible income if you're structured properly. Then there's also provisions that are detrimental to multinationals in the extent to where there are charges coming back from, say, Germany or otherwise back to U.S. tax return. They're actually telling those deductions that we don't like those as much. There's going to be a minimum tax. But
there's a lot of incentivizing of small business, a lot of incentivizing of U.S. businesses.
Definitely, they want. Honestly, the tax code is 100%. This Tax Cuts and Jobs Act is 100% favoring the onshoring of jobs, the bringing back of work to the United States, and it is disincentivizing work abroad, leaving profits abroad. I'll just put it that way.
Let's wrap this up with a question that may apply to a lot of people. The one thing I hear from people is they worry about an audit, whether they do it themselves, whether someone else does it. What, for the average taxpayer, not a business owner, what kind of behavior, what kind of tax filing, what triggers an audit? What is it that gets the IRS's attention?
So we ask almost every time that the IRS sends a notice to a taxpayer. We have clients that get audited, and we do a lot of taxpayer representation and successful taxpayer representation. The key thing is to be contemporaneously documented in your tax position. Contemporaneously means now, before you file the tax return. Have your documents ready, have your ducks in order, have your conclusions written down, put them in your file, put your file away that you know that you're safe and secure and that you've done all your work. Put it in your file, walk away, don't worry about it. I think it's less than 2% of the tax returns actually get audited. And of course, if you have income from a business and it's going like this and up and down, sure, the IRS may be looking at those a little bit more than otherwise, but an extension's not going to do that. Normal taxpayers should not be worried about an audit. The key is contemporaneously document your positions and be ready for them. They can go back 3 years and look at any tax returns, 3 years from the date of filing. So 3 years from April 15th of 2019, they can go back. They can go back more than 6 years. They can go back more than 3 years to 6 years if they believe there's a 25% or less tax underpayment. They can only go back more than 6 years if they can prove fraud, and that's a hard one to do. They have
what sort of thing triggers it?
They have to go to a court of law, and etc. They won't tell us.
Do you have a hunch, though? Do you have a feeling?
Yeah, there's wild swings of income, large amount of income one year, less than the other, huge changes in the type of income that you have, and zero this year, a lot of it next year. So it just, it's hard to tell. For your normal taxpayer, Jim, they just shouldn't be worried about it. They shouldn't be up at night worrying about it.
As long as they're being honest, as long as they're...
Correct. Contemporaneously documenting their stuff and being honest. It's just a low percent that get that audited.
That's good to hear. I think that'll be give people some comfort. Bill, I know this is a busy time, and we really appreciate you taking the time to talk to us.
Sure, yeah.
We've enjoyed spending some time with you, and have a good day.
Yeah, thank you very much.
Thanks for joining us.
Happy to be a part of it.
Thanks for all of those who joined in the conversation on GoErie Live this week. The video will be available for replay on the GoErie Facebook page and on the GoErie homepage. Thanks again to Gannon University for sponsoring this discussion. Thanks to William Finnessy for sharing with us today. And you can find upcoming topics and guests on the GoErie Facebook page each week. Thanks for listening.